In this video, I'm going to explain defined benefit obligations. So when we look at pensions, say in a county or a city or a school or a state, those governments make promises to their employees that they will pay them a certain amount of money when they retire. Now, these employees often work 10, 20, 30, 40 years. And so the full amount that a government is going to pay a particular employee doesn't appear all on one day. As the employee works, he or she is earning that amount that they will receive when they retire. So it makes sense that the government's liability is increasing over time. Now, let me give you a simple example. So let's suppose that a city has 50 employees and it promises each employee, we will pay you $1,000 for each year that you work for the government when you retire. And so, these 50 employees, they're not all the same age. Some are in their early 20s, some are in their late 50s, and so you have all different ages. But the government has made this promise, $1,000 for each year that you work. And so, say a 55-year-old employee, if she works till she's 65, she's earned the $10,000. A 25-year-old employee that works till he's 55, he's going to get $30,000 upon retirement. So the way we would compute the liability in this example is to take the present value of the expected future payments. Now, bear in mind, like in my example I just gave, different employees are retiring at different ages, and then some are younger than the others. So you've got to take all of this into consideration as you compute the pension liability. So that's why we have an actuary. So governments will hire an actuary to make certain assumptions about when people are expected to retire. We also have what's called a discount rate. And so the actuary is going to use a certain discount rate to compute the present value of the future expected payments. So in this example, the actuary is doing this for, say, the 50 employees. And that actuary will come up with a particular number. And we call this the net pension liability. And oftentimes we refer to this as NPL, for net pension liability. So if the government in this example sets aside, say, $25,000 a year to pay off this future liability, it has an asset in the plan and it's growing over time, and then it has a liability that's also growing over time. So when the actuary looks at the accumulated monies that have been placed into the pension plan, he or she, the actuary, is offsetting the net pension liability with the amount of funds that have been invested and placed in the plan. That's your net pension liability. Now, my example is very simplistic, and by the way, most governments don't promise in the manner that I just explained. For example, $1,000 for each year. But anyway, you get the idea of how an actuary might compute the net pension liability. Now, what I want to do is go to the financial statements and just show you how this appears on the financials. So going back to Putnam County, if we go to the statement of net position, we go down, we see long-term liabilities. In these totals, you have the net pension liability. Now, to see the amount of the NPL, we'll need to go to the notes. Before we go there, let me show you, there's also a deferred outflow for pensions. There's also a deferred inflow for pensions. We'll talk more about that in a minute. But let's go to the long-term debt note so you can see the net pension liability. In this example, we see the net pension liability here, and the total is $4.6 million. Now, the business type activities does not reflect an NPL liability, so the full amount of the pension liability is $4.6 million. Now, this does not include that deferred outflow and deferred inflow. Those show up in another note, and let's go there now. And by the way, at the moment we're in note number 6. Now I'm in note number 9, retirement plans, and we're looking for the defined benefit plan disclosure. Now I'm going to do another video on the disclosure part, but I just want to show you a couple of things here. So as we go down, we will see the net pension liability amount appearing here. Now that amount is the difference in the total pension liability here and the fiduciary net position. These are the assets. So when I gave that example and I said the government might set aside $25,000 a year to invest to pay the future obligation to the employees, this is that asset. So we have the liability. This is the present value of all expected payments, less the asset, the investments that this plan has at this time. And then the difference is that $4.6 million, which shows up in your long-term debt. Now, the other thing I'll show you while I'm here, here's deferred outflow, deferred inflow. So these are the amounts showing up on that statement of net position. And this information comes from the actuary. So generally these pension disclosures, even the language, often is provided by the actuary. And then the government will make adjustments. Sometimes the auditor helps the government do this, make adjustments to their amounts in their general ledger system so that the general ledger system then agrees with the amounts that we're looking at now. In this defined benefit plan disclosure, we see how the government is computing the liability or the promises they made to the employee about how much they're going to receive when they retire. You'll see a disclosure describing how that promise works. Then you'll see the active employees, retired employees, terminated. You'll also see the amount of contributions being made. You'll also see, and this is very important, the investment rate of return. So the higher this percent is, the lower the liability is. The lower this percent is, the higher the net pension liability. So this is an estimate. I mean, when they compute this defined benefit plan liability, they are using an estimate of the investment rate of return. Now you can guess that today you're going to have a return of 7% over the next 30 or 40 years. As we know, that is going to vary. So that's why we say this is an estimate, and it's a very significant estimate in computing this number. There's also salary increase percentages. So we're guessing that the salary increase would be 4%. Well, obviously that may change from time to time. We're using a certain mortality table. Well, this table changes from time to time. So at the moment, we have to assume certain assumptions in order to compute the net pension liability. And then we see a table of the investment types. So they've invested some money to pay off the future promised benefits, and that money's been invested with these allocations. And we say we expect these percentage returns on these types of assets. So that's, these are assumptions here. So we're projecting, we're making our best estimate of what we think would happen. And then we also see, plan assumptions down here, and they provide information about that. And then we get to the actual computation of this net pension liability. Now, I'm not going to go into a lot of detail. I'm trying to keep this simple, but you'll see various dynamics that are affecting this overall net pension liability. And then there's a sensitivity disclosure. Again, I'm going to do a separate video on the disclosure, but this disclosure helps me understand the net pension liability. That's why I'm doing this. So if the current discount rate is 7% and it dropped to 6%, then the liability is going up. If it went up a percent, then the liability is going down. So that gives you, some idea of how the discount rate change would impact the net pension liability. And then we have the deferred outflows and deferred inflows. So let's go back to the financials. We saw earlier that on the statement of net position, here's that deferred outflow for pensions, and there's that number. Here's deferred inflows for pensions, and there's that number. Then we said the net pension liability is included in these numbers. Now let's look at the governmental funds and see, do we see any amounts for the pension liability? Well, we've talked about it before, but this is modified accrual, so there should not be any pension liabilities here. And there's not, so that's the way it should be. Now, I would take you to the enterprise funds to see if there's a net pension liability there, but we saw in the disclosure that the enterprise funds for this government are not responsible for the pension benefit payment, so there's no amount there. If the enterprise funds were responsible for portions of this pension liability, then yes, the pension liability amount would show up on the enterprise fund because it's full accrual and it's using the economic resources measurement focus. Now I've taken you back to the statement of net position, and let's talk about these deferred outflows and deferred inflows for a moment. So I'll talk more about this in a subsequent video about what are deferred outflows and inflows, but just think of this as a temporary parking place for numbers related to the pensions. So suppose that the government had a 30% return on its investments in the current year, extremely high return. Well, that's very unusual. That's normally having about 7%. So if that happened, we would not want that full change to impact the pension expense in the current year, because if it did, there probably wouldn't be a pension expense. There'd be some pension revenue almost. So what GASB's done in GASB 68, they said, okay, governments, for those anomalies where the investment return is much higher or much lower than you would expect, we're going to smooth out that impact over the next 5 years. And you'll see, you can see amounts in deferred outflows or deferred inflows, depending upon whether or not those investments did above average or below average. Now, these temporary amounts, I said they're a parking place for this number. And then they're taken out of this parking place over the next 5 years, and they offset the pension expense. Now, they can either add to the pension expense, which would be the case for deferred outflow. As that gets taken out of here, it increases the pension expense in future years. As any amount here in relation to, say, large gains on investments that were deferred inflows, those would decrease future pension expenses. Now, there are other things or other factors that can impact deferred outflows and deferred inflows. So we had said sometimes you're making assumptions about mortality rates in relation to the employees you have, and sometimes those mortality rates aren't accurate. Then you could have a deferred outflow or inflow amount, and then that gets allocated back to the pension expense in future years. So the assumptions that we looked at in the disclosure, we're hoping everything will flesh out in that manner, but when it doesn't, and there are anomalies, then GASB, but through the deferred outflow, through the deferred inflows, they're giving us a mechanism to smooth out those variances. Usually these deferred amounts, they go away in 3 to 5 years. I won't say always, but usually it's kind of a short-term thing. But this is the parking place for those numbers when things don't happen in accordance with the assumptions that we had planned for. You may be wondering, where do the pension expenses appear? Well, on the statement of activities for this government, the pension expenses are inside of these numbers. So there's expenses. So they're a portion of these numbers. You can, in some governments, have pension expense in the business type activities, but in this government, they're all in the expenses for the governmental activities, since the governmental activities will carry the burden of paying these future net pension liabilities. Another thing before I go is when you have defined benefit plans, you're also going to have required supplementary information that includes information about the defined benefit plan over the last 10 years. And so you'll see a table like this in the required supplementary information section. There's that net pension liability, we see it there. And then there's also a schedule of contributions, and we see that here. And then some notes that explain these schedules. So just be aware when you have a defined benefit plan, you'll also have some required supplementary information. Okay, I've tried to make this as simple as I can. It's no easy matter, but think of it this way. A government, when it promises all of its employees future pension payments, then it's going to accrue a liability over time as each of these employees are working, and then that liability will be paid out upon the retirement of that employee. The government's also often, almost always, putting money into the plan, the defined benefit plan, to pay off those future obligations. The difference in the two, that's the liability, and that's what shows up on the statement of net position. I hope this helps when you think about defined benefit plans.